Trillions of dollars move through the global derivatives market every day, governed by highly complex algorithms and executed in milliseconds. But long before fiber optic cables and digital exchanges, the mathematical instinct to isolate risk was born here, in the sunlit groves of ancient Greece. The philosopher Aristotle recorded the story of Thales of Miletus, a man who used his knowledge of meteorology to predict an unusually massive olive crop for the upcoming summer. Instead of attempting to buy the olive presses outright, Thales paid the owners a small sum of earnest money in the winter. This fee locked in a low rental rate for the presses at harvest time. He bought a privilege, not a physical object. When the bumper crop arrived, demand for presses spiked. Because Thales already held the rights to the equipment, he sublet them to the desperate farmers at whatever price he chose, turning his small initial fee into a fortune. Thales had executed what we now call a call option, paying a premium for the right but not the obligation to use an asset at a later date. It places a strict boundary on your downside risk while leaving your potential profit open. Fast forward to the Middle Ages, and the stakes of prediction shifted to the sea. A single merchant vessel battered by a storm carried enough physical cargo to either build a family dynasty or ruin it entirely. To protect against total ruin, merchants began writing to-arrive agreements at seasonal fairs. These contracts established a set price for a cargo of grain or whale oil, conditional on the ship actually surviving the voyage and making it to port. Soon, speculators who had nothing to do with the physical cargo started getting involved. They treated the shipping lanes like a public wager, placing side bets on which ships would return and paying upfront premiums to walk away from bad contracts. The sheer volume of these wagers outgrew the chaotic, temporary tents of the seasonal fairs. Managing this level of risk required permanent, dedicated markets. This 1531 engraving shows the Antwerp Exchange. It was one of the first indoor, permanent forces, featuring an enclosed courtyard designed specifically to organize and structure daily trade. By the 1600s, the center of finance shifted north to this packed crowd at the Amsterdam Exchange, obsessively trading shares of the Dutch East India Company. Look at this 1606 VOC registration document. Transferring a single share required 2 directors to sign thick ledgers in cursive. It was slow, cumbersome, and completely unsuited for high-speed trading. The Dutch bypassed this physical bottleneck by adopting a clearing process called resancre. Instead of exchanging paper certificates for every trade, buyers and sellers kept running tallies of their positions over a 3-month period. On settlement day, the physical asset never moved. Traders simply calculated the change in the stock's price since their initial agreement and paid each other the difference in cash. Speculators could now buy and sell massive volumes of stock they didn't actually own. This continuous trading provided the market with liquidity, ensuring that buyers and sellers could always find someone to take the other side of their position. By separating the financial risk from the physical transfer of the asset, the Dutch created the architecture of modern derivatives. Look at the specific color variations in this botanical print of the Tulipa Maire. In the 1630s, non-professionals like weavers and bakers began buying unbacked forward contracts for tulip bulbs like these, hoping to flip them for quick cash before settlement day. This satirical engraving from 1637 shows the aftermath. When tulip prices suddenly collapsed, speculators found themselves holding contracts they couldn't afford to settle. Lacking the physical goods or the cash to back up their trades, thousands defaulted. The Dutch courts ultimately voided the bulk of these contracts. The crash proved that while speculators generate essential liquidity, the market system only survives if participants possess the capital and integrity to clear their debts. This tension between legitimate trade and unbacked speculation eventually traveled across the English Channel. Here, in the crowded inner courtyard of London's Royal Exchange, formal share trading took root in the late 17th century. But the more speculative derivatives trading, known as stock jobbing, was pushed out into the coffeehouses of Exchange Alley. As this period print warns, the alley was filled with unthinking fools running to humor knaves in pursuit of massive options payoffs. After a series of financial panics, the British government tried to stamp out the practice. In 1733, Parliament passed Barnard's Act, explicitly outlining the speculative trading of options and time bargains. The law failed to stop the trading, but it did have a severe side effect. It removed all legal protection from the contracts. If a trader lost an options bet and refused to pay, the winner could no longer take them to court. Brokers were suddenly acting as principals, completely exposed to the risk of default. The only way to survive was to trade exclusively with people you trusted. Personal reputation became the sole collateral for millions of pounds in financial agreements. To protect themselves, a loose network of honorable brokers banded together. They enforced strict rules of conduct and excluded anyone who failed to pay their differences. This private club eventually acquired its own building and became the London Stock Exchange. A moment of wonder. In an attempt to destroy the derivatives market, the government forced it to regulate itself, creating the institutional integrity that turned London into a global financial capital. Today, the coffeehouse ledgers and physical settlement days have been replaced by these humming data centers, where millions of option contracts execute in milliseconds. Yet, the mechanics are identical to the bets placed in ancient olive groves or 17th century Amsterdam. Traders pay a premium to fix a price, bound their downside risk, and capture the upside. Options allow us to untangle financial risk from physical reality, providing the ultimate mathematical tool to engineer a profitable path through an entirely unpredictable future.